Okay, I'm going to do a different presentation for each method here, and we'll start out with net present value. And the methods that come from now on are all discounted cash flow models, all right, to make capital investment decisions. And this is what I actually used at work. Now, net present value and internal rate of return consider the time value of money. Okay, so then you're really looking at apples to apples when you make decisions. And it relies on present value calculations, just like we did earlier, to compare the cost of the initial investment with the expected cash inflows. Okay, so you want to make, you've got a certain return that you want to make in a business, and that's what these numbers help us figure out. So here's an example of Allegra is considering two potential investments. Both cost $1 million and have a 5-year expected life with no residual value. And these are the predicted net cash inflows. Okay, so we've got two investments that both cost $1 million. So the smartphone investment is $1 million, and this is the cash inflow here. And the speakers cost $1 million, and this is the cash inflow from them. Okay, so to decide how attractive the investment is, we find the net cash flow, which is the difference between the present value of the investment's net cash inflows and the cost of the initial investment. And then we discount the net cash inflows to their present value, okay, just like we did earlier, using the minimum desired rate of return. That rate is our discount rate, or our interest rate, okay? And it's also called the required rate of return, or the hurdle rate, because the investment must meet or exceed this rate to be acceptable to the company. And the discount rate depends on the riskiness of investments. Okay, you won't have to figure out what that is. That'll be given to you. The higher the risk, the higher the discount rate. Okay, and Allegra's discount rate for these investments is 14%, which today would be really high, right? But interest rates move all over the place. We compare the present value of the net cash inflows to the cost of the initial investment to decide which projects meet or exceed management's minimum desired rate of return. Okay, so in other words, management is deciding whether the $1 million is worth more because the company would have to give it up now to invest in the project, or whether the project's future cash net inflows are worth more. And managers can make a valid comparison between these two sums only by comparing present values. Okay, now there are a lot of other things that go into decisions like this in terms of what you expect from the market and where the economy is, and a whole bunch of other decisions, but this is a good start for financial comparison. So the smartphone is going to generate $305,450, which is in each year for 5 years. So we'll go to the annuity table and look up 14% for 5 years. There's our payment, $305,450, and the factor is 3.433. So that will return $104,810. Okay, so here's a nice table, that one way that you can show it. The book does it this way, but I tend to put things across, like times 0, then year 1, 2, 3, 4, 5. I suppose it's just the way you were taught, or the way you did. That's what I did at work. But here's our present value of our annuity. So we've got a cash inflow of this is kind of small, $104,810, and less the initial investment. The initial investment is $1 million. So the net present value of it is really only $48,610. Okay, I mean, maybe this business would let you get into other businesses. Maybe it would get you in with other customers who you wanted to get to know. There might be a million other reasons to do it, but it's not overwhelmingly wonderful when it comes to money. Decision rule: if it's positive, invest. If it's negative, don't invest. The one thing, it might be only 48,000, but it does meet the hurdle rate, or the discount rate. So in this case, the smartphone project would be an attractive investment. It means that it earns more than Allegra's 14% target rate of return. Okay, so if management gives up $1 million today, okay, they would get future net cash inflows of more than $1 million in today's dollars. Okay, we get that 1048. Then in the other one, we had, for the speakers, we had unequal net cash inflows. The net cash inflows from the speaker are 500 in year 1, 350, 300, 250, and 40,000. So what we'll have to do is use the present value of a lump, okay, of 1. And then we set up a table like this. So here's my excuse me, year 1 through 5. And this is the present value of my net cash inflows. These are the factors for those 5 years times the cash inflow for that particular year, and this is the present value of those dollars. Okay, so this brings it back to today's dollars. So the present value of net cash inflows is 1078. The initial investment is $1 million. This one is making $78,910. Okay, above that initial investment. So it meets the 14% discount rate, or that requirement. Okay, and it's got a pretty good return here. Alright? So with unequal cash flows, you've got to put down each year individually, and then hit it times the present value factor for that year. Okay? So this would be in year 1, 2, 3, 4, and 5 at 14%. Okay? And again, it's the present value of a lump. It's not an annuity because the amounts differ year by year. Okay? And the next one we'll look at is Profitability Index.